Hey, welcome to the Closing Beat, everybody. How you doing? Coming to you from the Closing Beat studios here. Actually, it's Jazzwell Studios. I'm saying a Closing Beat. That's our Closing Beat set. You can see me way over in the corner there. Off to my right, we've got the Wine and Wealth coming to you tonight. It's not lit up. We forgot to turn the lights on there. But I hope you will join us tonight for Wine and Wealth. It'll be available for research members as well. We're going to talk about all the data about a bear market that you could ever possibly want to see, and I'm going to show it in like 7 minutes, right? So I'm really going to break down hours and hours worth of data into just a really simple way that we can see everything, and we'll spend as much time as you like on it. Come have a glass of wine with us. If you're a research member, of course, that is included tonight. If you're one of our clients, hey, if you can make it, come hang out. I'll stick around as long as you like, answer all the questions we can. But today we're talking about the stock market. And Thursday, no, not Thursday, it was Tuesday's show. The title was, man, is this the beginning of a stock market bounce? Today, turns out it is the beginning. That was quite a big move we actually had here today. We're going to cover that. And I've got some really cool ways to share some data with you that maybe puts you at ease here because last week in our Wine from Well, in our Notes from Jazz, we got too many names around here. This is the way it looks if you're one of our clients there. I don't like to hit you with the boring stuff. We talked about, hey, the markets fell again, but the markets are almost done going lower. I love to set you up for that, to show you why the stock market is in a position to start to at least settle in there. I'll be honest with you, I didn't claim to say that the stock market was going to bounce. I just said it was about to stop going lower. And so I love doing that. And I don't do that just to show off. I don't come here just to show off and share data and studies and stuff with you. I come here to sort of set the mind, right? If we know that we got to buckle down and hold tight because it's going to be a little bit rough, if I could tell you that ahead of time, isn't that better than me waiting for the market to get weak and then go, sorry, things are weak. So I do the same on the way up. If I can give you a heads up that it's okay to go live your life for a little bit, you don't have to worry about the stock market for a week or two because of X or whatever we're sharing. That's why I do that stuff. I love it, man. At least half of investing is up here, man. If you can get your mind right, you can get your dough straight. And that's our new saying there. I just came up with that. That's going to happen. Hey, so FinTips is a class that we do every day, 1 o'clock. It's recorded. It's free. It's right on our YouTube channel. This week is focused on inherited IRAs. I had a feeling there was a lot of that info that needed to be shared. I've gotten tons of feedback on that, so I'm glad we spent the time on inherited IRAs. Next week, we are going to have a different topic, right? And we'll just go on and do those sort of things there. All right, stock market stuff. We got to talk about this. There is a lot of talk about the first 100 days. Oh my God, the first 100 days is over. Data, yay, let's talk about it. We're going to jump on that bandwagon here today. The NASDAQ, I might want to point out to you, has had officially the first worst 100 days ever in its history, losing 27%, again, in the first 100 days. Forward returns are actually not very good when the first 100 days starts off very poorly. What we're talking about here, and I'm going to spend a second just talking about this, even though this might take a minute. Here, I pulled this up for you. They're saying the worst 100 days of a pullback. Now, what I've done is I said, okay, the first 100 days, what are we going to use there? The data sucks. I'll show you in a minute. It's not very good. But when the NASDAQ pulls back off of highs, okay, that's more interesting. So this chart here shows every pullback off of highs, the previous high, and how far did it fall. So as of yesterday, we had actually fallen more than what we lost through COVID. So that was rather impressive. We'd actually fallen 30% at one point. And so what's more interesting here is, what if you invested in the NASDAQ when it fell 30%? There wouldn't be many opportunities to do that, but what would that look like? Because that's where we're at right now. So there's only a handful of different data points, and let me share it with you here real quick just to make it look interesting. Here is the NASDAQ's performance over various time periods after falling 30%. In the next 1 week, it averages a 3.6% gain. It's 1 week. We're not really interested in that. 1 month, 7.7, and then bam, off to the races. In the next 3 months, the NASDAQ tends to gain 17%, 6 months, 21.5%, 1 year, 22.4%. Now, the question you ask yourself is, should I be participating in that, or is that just kind of normal? Take it a step further here, right? I'm going to go one more step further. Let's pretend that you avoided the 30% declines versus being always invested in the NASDAQ. right? Because they always say if you miss the recovery bounces, you miss some of the best returns. Well, this is so super true for the NASDAQ. Look, if you invested at any point throughout the NASDAQ's history over any 1 month period, you'd have an average gain of about 1%. Over 3 months, you'd have about 3%. And we look back, I believe we went back into, because you can only go back to 1997, so this includes the dot-com bust. 6 months, 6.2% and 12.8%, just the average, right? There's obviously going to be times that it's not that. Well, look back over here for a second, right? So if you bought after a 30% decline, you dwarfed your sort of index fund based investing there, right? So the moral of that story is you have to be in the market during some of the downtime so that you could participate on those massive bear market recoveries there, right? And that's exactly what this would be, is a bear market recovery, because you're down over 20%. So you definitely have to participate in that. If you miss that simple little bounce, the start of the bounce, even 1 month of the market's bounce, the NASDAQ bouncing, and you go, oh, I'm nervous, I don't want to be in, you just missed out on 7.7%. You can't get that in any 1 month period on average. So you've got to look at that sort of thing. And I thought this was a great day to share that kind of stuff with you. Okay, now let me go over here. We're going to look at the S&P because I'm not done there. The NASDAQ was fun, right? Yay, we looked at the NASDAQ, right? We look at the S&P. And here we have obviously a rally today, and S&P is doing its thing. It's the worst in 52 years, a 72% drop, right? Sorry, a 17% drop. I think I said 72. 17% drop in the first 100 days. It's the second worst ever. The worst was 1970, if you're familiar with that one there, which was pretty nasty. And we're going to talk about that. So let's go with what we just learned. And now let's do the S&P. Let's say, what happens if the S&P has this really horrible time period and we want to invest in it after only 100 days? So our strategy is only invest during the worst 100-day period. So we took the top 10 worst 100-day starts to the S&P and we said, let's just pretend that that's all we did. We cared less about investing any other time. Pretty poor performance. You would not want to use that as a strategy. Remember on Tuesday we were talking about strategies and how to come up with stuff. Well, here's one you could have proposed. Horrible 100-day performance, I invest going forward. Well, 1 week later you'd have a 0.5% gain. 1 month later you'd average a loss of 1.1%. 3 months later 1.1%. 6 months later negative 1.5%. And the rest of the year you'd be at 2.9%. So if you only picked a year that was down one of the 10 worst 100-day starts to the year, it wouldn't be worth your while. Compare that to just investing in the index and saying, oh, forget about all this stuff, just get me in the index, I'll go. You'd be better off doing that. So in other words, the first 100 days analysis doesn't mean anything, right? There's the data to show you. It could be the worst 100 days ever to start, and the average performance going forward is no better than you just investing in the market and holding on tight and getting your dough straight doing other things, right? So be very careful when you fall for headlines that seem sort of seasonal and exciting or interesting. It may cause you to think of a strategy, but in reality, what'd you get? You got nothing. You could have just been invested in the market. All right, that was a long way to say all of that, but that took a lot to put together, and so I like to share that with you, and hopefully you learned something there. If we look at the markets here today, a lot of the normal stuff, I don't have to go line by line. We don't have to talk about too much here. Mean reversion, right? We've been kind of talking about this too far, too fast to the downside. Mean reversion is just a fancy way of saying a bounce in the market that causes all the indicators and oscillators and stuff that's out there to come out of oversold territory. Are you like a MACD person? Are you a stochastic person, RSI person, right? All those indicators say the market is oversold, right? What makes those indicators, all they are is math models, what makes them become neutral again or out of oversold? What's called mean reversion. So if you look at the S&P, mean reversion for the S&P means back towards and to the 50-day moving average. You notice how anytime it gets too far away, it likes to come back to it? This is not like magic. It does it. Anytime it goes too far to the upside, it likes to come back. Any stock, any sector, any index does the same exact thing. It's just hard to guess the bottom or the top, right? So I'm not saying you could do it, but we know that it will revert back to the mean at some point. Well, when the market comes back here, this is where no longer can the stochastic investors, if there are any left on the planet, say that the market is oversold. No longer can RSI investors say the market's oversold. No longer can all of those indicators, your Bollinger Bands, whatever you want to use, all of a sudden, when we make our way back to the 50-day, go look. Every one of those indicators or oscillators is going to say neutral or will not be at a trigger point there. What does that mean? That's where you tend to lose some steam. The stock market says, okay, the glass is not half empty, not half full. What do we do now? Well, let's think about it. From here to there, if we do revert to the mean, is the fancy way of saying it, let's go down here and say that's about 5.2% higher. So that's the range we're talking about in the stock market, 5.2% more to the upside, and we really wouldn't have made any progress. We would have just reverted back to the mean, and everybody would say, what now? So that's the target area. That's where people will look, because at the moment, your stochastics say, it's a buy, bud, get in there. RSI, it's a buy. All of that stuff. Your momentum indicators say, it's a buy, right? We're oversold. That's where people all of a sudden draw back their dollars. And I'm talking a lot today, but man, there's a lot of cool stuff to share out there with you. Let's move on. I'll take your questions and everything after this. Oh, I got to point this out real quick. Oil, sorry to tell you, oil's up another 3% today, $114 a barrel, and nobody seems to give a damn. Not that there's not some nasty stuff that just happened in the U.S., of course, that's horrible. There's a lot of that happens. I don't know why some of it makes TV and some of it doesn't, but all of it's horrible. But we got a problem here, right? We got to figure out this gas thing, because this is getting annoying that nobody's focusing on it. I hope we don't, and I don't care who you want to vote for, I hope we don't go into the midterm elections and our biggest conversation is how in Florida you now can't say the word at school, when that really wasn't a thing. We need to focus on the things that's obviously we can all agree on, and I hope that that's how the midterms play out for us. Don't let them distract you out there. We got to focus on things that matter, not things that two people in the whole United States care about. Anyways, that was a sad story about oil, you know. I can't do anything about it for you guys, but I can tell you there were 20 new highs today. Sadly, it was mostly energy stocks. So I'm trying to sound upbeat about this, but if you're invested in energy, you got new record highs for energy. Boy, it's just a tough one out there. Not all-time highs, I should say. Energy has not made all-time highs. Given that it's already up 50+%, nearing 60%. But no, not quite there yet. I thought a name that looked interesting was ConocoPhillips. I mentioned this the other day when it was breaking out. It is now past a point where you could say, let's hop on that bandwagon. You've got to sit back and kind of rest for a minute. Bristol Myers was the other one that made new highs. It's attempting to try to break out. Gotcha on this day. Didn't quite get it done there. It's trying again. I would say it still looks strong. It's just taking its sweet time. Apache very much looks like Conoco. You just can't chase it here. It is obviously strong. It's just making a new high, trying to suck in the last of the people they want to play. Diamondback, waking back up again, hitting highs. Not something you want to see as a consumer, but as an investor, hey, awesome. You know, good stuff. Medtronics was the only low today. It actually did kick a new low there at the end of the day. I do follow them, so I mean I can help with questions on this one. This was earnings related. The cardiovascular unit was the only one that actually had higher sales. MedSurge, diabetes, and others, they all lost money, and they blamed it on China from both the supply standpoint and, of course, to the end user standpoint. It just wasn't good for them. And the other part is they said going forward, we don't see a bright spot on a horizon for the rest of the year. And so that's enough to get you a loss of, 6% on the day. And it's not like a headline stock, but it's one that I do pay attention to. So I could probably help a little bit more with that one there. Yeah, that's it for new highs and lows. Stocks in the news here. What do we got? Hey, Chinese stocks. Did you see them? I know you guys like your Chinese stocks. Where are you at out there? Baidu. Go Baidu, right? Up 15% on the day. They had earnings, so there was actually a couple of them. Some of the headline ones like Baidu and Baba, and some that weren't. Baidu beat there, obviously did really well, and I thought it was funny that they focused on these words, but they said, we're going to continue to generate impressive cash flow, right? Because they know people like that word, cash flow. So they got that going there. Alibaba, I'll just point out real quick while we're here. They didn't hit a record, but they do have a new record of active customers on the platform. So that's good news for them. They also mentioned cash flow. They're going to continue to generate, and how could you blame them there? So is that the bottom? You know what I mean? I know I'm going to get that question from one of you, and I don't know. This is not the most impressive attempt at a rally that we've seen recently, but all of those other impressive attempts at a rally failed. So I don't know. I'm not going to be one that says go for it here. I'm going to play conservative. Southwest Airlines there. Boy, if you want to be a pilot right now, now is the time to get out there. Second highest paying job in the United States at the moment. Those guys, they make a lot more than I thought they made, to be honest. I did not know the truth there. Anyways, plenty of jobs to be had at all the major guys there. They come out with earnings, and it was all great for Southwest. Not only what happened, you can kind of estimate that things are good, but what they were focused on was going forward, right? Yes, we have higher costs, but our pricing power, remember, that was the key phrase that was going to be used this earnings season there. They said our pricing power, bookings, and future bookings, of course, have more than offset their rising costs. Boy, isn't that what you want to hear if you're investing in a company, right? Your margins aren't going to compress because you have pricing power. You have people that want to fly your airline and willing to pay more, and you can pass the cost on to them. Good. Hey, speaking of passing prices on, I don't know if you've noticed, but the high-end retailers are killing it in the luxury space, right? People that can spend money and afford to spend the money on things that you could just go to Walmart and buy the same one for $8, but nonetheless, here's my example. Williams-Sonoma, expensive pots and cooking stuff there that my wife falls for every now and then. They're not feeling the pressure of inflation. They're like one of the only retailers that says, it's all good over here. People are spending good money. Look at Nordstrom. I was not here yesterday, but Nordstrom said the same thing. They said our high-end luxury buyer, which is pretty much who they cater to, they're here. They're spending money. We have no issues with them so far. And by the way, they don't see that changing. So that luxury space, if you have to invest in retail, is really standing out as the place to be. Even Macy's. Macy's saw really, really strong sales in their luxury products, right? Not so much as you move down brand, but hey, people that have the money are spending it. And what does that mean? Bigger profit margins, right? The shirt that's $80 versus the shirt that's $12. It's the same fabric, right? So bigger profit margins for them, and they said it, not me there. A great example. Here's a great example. After hours, the Gap, moving down the income spectrum inside of retail. So if you have less money, you're not shopping at Nordstrom. There's no way to sugarcoat it. If you don't got the dough and you're not shopping there, you're going to the Gap. I happen to like the Gap, but investors right now don't happen to like Gap because, well, we're changing our buying habits. We got to spend, $50 more on a gallon or on a tank of gas. Well, we're not going to maybe go buy that new shirt, even though it's maybe $12 or something at the Gap. We're just not going to buy the new shirt. So anyways, they've got problems after hours. That was not nice. Their earnings quarter anyways. And the Guess is another one. Same concept there, right? You get what I'm saying. Hey, NVIDIA, you probably heard it. By the way, during COVID, NVIDIA was almost worth $1 trillion. Remember that? That right there? That's over $900 billion in market cap, meaning the valuation of their company there. Well, it's half of that now. So let's hope that doesn't happen to your company if you're out there, because I don't know who can have half of their company shaved away from them like that. Nonetheless, the earnings have come out. They did lower guidance going forward there because of, oh, darn it, I read it this morning. The kids that play the games, well, they're back to school. They're back to work. Us grown-ups that like to go home and play games for hours, we can't do that during the day because we're not working from home as much. So that's part of it. We also spent all of our money to build our gaming systems while we were sitting at home doing nothing. I personally built a flight simulator, so yeah, I helped support them there. Well, I don't have time for it now, so we're all back to work. Anyways, that's what we got here for today. I feel like I said a lot. I hope I helped you. And yeah, Marcus, I have been one who has walked through, I don't remember where it was. I think it was at the Mall of America one time. I walked through Nordstrom because I heard a piano playing, and I was like, I like music. What a great idea. They got music in the store. I fell for it. I'm walking around like, well, while I'm here, I'll shop a little bit. I didn't buy a damn thing. It was a shirt that was $80. Had an alligator on it. It shows you how average of a guy I am. I'm not that we could probably all spend $80 on a shirt if we wanted to, go home, get yelled by our wives, then sleep on that couch with the shirt you just bought. But really, even if you could afford to buy 40 of those shirts, why? What are you doing? They got you. Yeah. Old Navy's doing the, what is a woke size? Cody? Are you familiar with are you over there? Are the kids into something like that? Is it like a half size? Is that, I don't know. Oh, maybe don't call it large. Yeah. Okay. What? Well, all right. I don't know. I don't know enough about that one there. There you go. Yeah. Oh, you like the dividend there on Medtronic. Okay. No problems there. 100% EV. You don't like the EV there? Well, so I'm big on that. I've been saying that since the ethanol days when we all thought we were going to let corn and basically power our cars and trucks. There can't be one source of fuel. There can't be one type. I mean, it's great. You want an electric car, electric car. You want a gas car, gas car. You want to do hydrogen or some combination, great. We all have to do that. That's the only way this works. You can't just, we can't all drive battery powered cars. And that's a math model. That's not an opinion. So I don't think anybody disagrees anyways. What happened to inflation pressure? I'd like to see this come back down. The assumption is inflation has peaked. Do you feel that? The assumption now is that the Fed has done everything that they promised they would do, and it's working, and inflation will peak from here. We saw a little decline there on that last CPI number, but I wouldn't say enough to call it peaked, but yeah. You sold $250 shirts in the 80s. I hope you sold a lot of them. It seems like if people are willing to pay $250 for a shirt, you crank them suckers out. Yeah. Bingo on the EV thing. Yeah, and I don't think it's a topic that people debate. I know there's obviously people that believe strongly in EVs or believe in emissions and climate change and all that. Okay, cool. You just do a little bit of everything, it'll be great. And that's probably the direction we're going to be forced to go, because you can't do an all or nothing approach there. Oh, you're looking for a multi-day rally from here. Well, you would expect, and this is the test for the market, you would expect, right, tomorrow the market to be down 1%. Would you not? That's what we've seen. We're being trained to kind of see that. That's the volatility right now. So if that doesn't happen tomorrow, is that not a really, really good first start to the stock market? Maybe bouncing, right? We've been saying there needs to be a catalyst. Well, there are no economic catalysts on the horizon. There are no political catalysts. There's no fundamental catalysts. Earnings season's largely done. So if we have no market reason for a bounce, we got to take the little wins and watch how, if the market is just even up 0.25% tomorrow, that's a little win after what we've been through. And you see people approach things differently. Now, if we open up 1% tomorrow, game on. Down 1%, then you know what? This is not done yet. We still have a lot to go. But that, to me, is a little win if we can get that to happen. Yeah. The Fed has won. They can declare victory. I don't know if they can, and I don't know that they will be declaring victory. I think their comments will not even come close to that. They're bright people. They're going to say we're going to continue to hammer down this inflation. June 13th, 14th, somewhere in there is the next Fed decision. We're expecting a 0.5% raise again, by the way. Yeah. Yeah. Cool. We're good? Everybody good? Did you learn something today? I hope you did. We put a lot of effort into this show. It doesn't seem like that with my rambling sometimes, but it all comes from a good place of research and thoughts and stuff. My opinion really doesn't matter, but if I can share data with you, well, that's something you can take with you and, you know, use and hopefully learn from. Well, I hope you like data, because tonight, Wine and Wealth, I've still got to put some pieces together here, but we're going to cover some data. You may need a drink, actually. It is called Wine and Wealth, but you can call it Whiskey and Wealth. But, you know, we didn't trademark any of that stuff. You're welcome to call it what you will. But we're going to cover some data tonight. I hope you'll join us. It'll be in the dojo for clients and for research members. And we're going to find something to drink around here, talk about a bear market, just in case tomorrow we start falling again, right? Just be ready for that. All right, the rest of you, get your dough straight. Have a great rest of your evening, and we'll be seeing you.